with the help of Cash App, Klay Thompson has very famously taken some of his Golden State Warriors salary in cryptocurrency, $22.4 million worth of it, and then donated $1 million in Bitcoin to fans. Green Bay's Aaron Rodgers, also a pay me partially in crypto kind of guy, along with Eric Adams, the mayor of New York City, who took his first paycheck in January of this year in Bitcoin and Ethereum. Last week, though, FTX, started by Sam Bankman-Fried, went bankrupt, sending a ripple of chaos through the crypto world and making many question just what they're doing in these exchanges. Sac State professor Joseph Taylor, an expert in cryptocurrency, with me now live to explain some of what's going on and what it may mean for the wider American economy. Good morning, Professor.
Good morning.
Okay, for those who still may not quite understand what crypto really is, please give us your most succinct description.
All right, so a cryptocurrency is just a currency. So here I have a dollar bill. This is a U.S. currency. It's issued by the Federal Reserve Bank of the United States. Cryptocurrency, it's a currency just like this, or a euro or a peso, but it'll be issued by some collection of Bitcoin Foundation or Ethereum or BTX.
Okay.
And that currency can be used to buy stuff if somebody's willing to accept it. But to use it, you've got to find somebody willing to accept it.
Exactly. So with FTX collapsing last week, there are lots of losses. A teacher's pension plan in Ontario, Canada, is looking at $95 million gone as a result. We're not aware of any American teacher pension plan invested this way, luckily. Senator Elizabeth Warren has said too much of this industry is smoke and mirrors. The FTX failure is under criminal investigation in the Bahamas and now part of a class action lawsuit here. And all of this is being looked at as a major hit to cryptocurrency's credibility overall and an invitation to what some say is unnecessarily restrictive regulation. But couldn't better regulation have stopped this from happening?
Well, yeah, it certainly raises some very interesting questions. So from a cryptocurrency standpoint, that's just like any other currency, something that can be traded. But what happened at BTX is it wasn't just about the cryptocurrency. BTX was engaged in a lot of financial services transactions. So they were selling their
version of the dollar
cryptocurrency. And they were using the money that they received from their investors to invest in other high-risk financial services. And then when some of their people who owned their cryptocurrency became concerned, they essentially had a run on the bank. And as their customers started to try and trade back their cryptocurrency for their dollars or yen or euros, whatever they used to buy the cryptocurrency, BTX or FTX didn't have enough, and it caused them to quickly go bankrupt. And yes, certainly if they would have been regulated like a bank, they would not have been allowed to pursue many of the transactions in which they were engaged.
We know the SEC is doubling the size of its crypto department. Part of the lure of these digital assets is that they're secured by a decentralized network of computers, rejecting the premise of being controlled by a central bank or government like the U.S. dollar, so one entity can't manipulate it. With so much of the industry operating overseas, perhaps because of lack of SEC clarity here, is doubling even enough at the SEC to keep track of it all?
Well, I think we need to have a broader conversation about what our strategy is in terms of understanding what these companies do. So FTX was really engaging in financial services and investment banking activities, which is not necessarily what Crypto.com does or Binance does or some of these competing platforms. And one of the challenges that come with cryptocurrency is the value of this dollar depends on supply and demand. And the Federal Reserve can really control, governments can control what the supply and demand of money is. But in crypto, that supply tends to change more slowly because of the way crypto are mined. And as a result, it means that it can be susceptible to very fast changes in price, both up and down, as that demand changes, which is precisely why we're seeing some of the upheaval we see right now, not just in FTX, but across the broader cryptocurrency market, is a lot of casual investors are beginning to realize that this is a lot riskier than they necessarily thought when they were buying their first Bitcoin.
Well, Bitcoin has kind of been the gold standard in this game. Still, Home Depot, Overstock, and Shopify are some of the very few places accepting it. It hit a high in November of 2021 and since has lost about 75% of its value. So what happens now? Will other retailers be scared off in terms of accepting by what's happened with FTX?
Well, speaking from the retailer perspective, there's certainly a concern because if the value changes a lot, retailers have a lot of risk when they accept Bitcoin as a payment. As they take Bitcoin to buy a new chainsaw at Home Depot, that $200 in Bitcoin might only be worth $50 in 6 months. And that's the type of risk that a lot of retailers aren't comfortable in taking. If the prices were to stabilize so that it was predictable, we would probably see more retailers, more banks, more financial services company accept cryptocurrency as payment. But as long as the price is so volatile, it makes accepting it potentially risky.
Alrighty, well, we have to study all of the investments that we make, but folks who are interested in this are definitely going to have to do a lot of study for cryptocurrency. Thank you so much for helping us to understand a little bit more about the industry.
All right, thanks. Have a great afternoon.
You too.